Welcome to This Explainer. Today we're unpacking the real driving forces behind Globe Life's highly impressive Q2 2026 financial results. When a major insurance player drops numbers like these, it gives us a fascinating window into consumer behavior, their distribution strategy, and just sheer operational efficiency. So we're going to break down their official earnings release to see exactly what's working, where this growth is actually coming from, and what potential headwinds they're keeping a close eye on. Let's kick things off right out of the gate with a massive headline from the report, a 20% increase in net income per share compared to this exact time last year. We're talking a jump from $3.05 per diluted common share in Q2 2025 all the way to $3.65 in Q2 2026. For a mature life and health insurance company, seeing a 20% bottom line expansion in a single year, that is a powerful indicator of a highly optimized business model operating at full tilt. And as management points out in the release, this isn't just a one-off stroke of luck. It's a sustained track record of double-digit momentum. They've produced double-digit growth in net operating income per share in 8 of the last 9 quarters. That kind of consistency tells us we aren't just looking at a lucky break in the market or some favorable seasonal shift. We are looking at a deeply embedded growth engine. This momentum is so undeniable that they've actually raised their full-year 2026 earnings guidance to a new range of $15.55 to $15.95 per share. That's a 10-cent increase at the midpoint. What you should really take away from this is management's incredibly high degree of confidence in the back half of the year. They're looking at their internal metrics and signaling to the market that this pace of profitability is built to last right through the rest of 2026. Okay, so here's our roadmap for today's explainer. We're going to cover 1. The big headline numbers. 2. Life and health margins. 3. The agent growth engine. 4. Investing the premiums. And 5. Looking ahead to the future. Let's dive right in. Section 1. The big headline numbers and record growth. First, we really need to lock in the fundamental scale of the total revenue growth before we start looking under the hood. So looking at the top line, total premium revenue grew an impressive 7% to nearly $1.3 billion for the quarter. To be exact, it hit $1,297,622,000. Why does this matter? Well, because in the insurance business, literally everything flows from premium revenue. It's the fuel for the entire operation. An increase here means they're successfully acquiring new policyholders and retaining existing ones at a much higher rate than last year. Moving on to Section 2, Life and Health Margins, the core business. Let's see how that top-line premium actually translates into real profit across their 2 main pillars. When we map out the insurance underwriting margins, it is crystal clear that life insurance is the dominant engine here, driving 78% of the margins, with health contributing the remaining 22%. The life segment saw a 6% growth in underwriting margin to over $359 million. They're writing basic protection life insurance policies, which the source notes generate really strong, stable cash flows that simply aren't impacted by volatile equity markets. But if we look closely at the health segment's distribution channels, United American was a massive standout, generating a 29% jump in health premiums to over $211 million. Overall, health premium across all channels increased by 16%. This is a perfect example of why a multi-channel distribution strategy works so well. Even if one segment, like direct-to-consumer or American Income, stays relatively flat, a sudden surge in an independent agency channel like United American can lift the entire health segment's performance. All right, Section 3, the agent growth engine. Boots on the ground. The absolutely crucial question here is, what is actually powering these increased premiums across the board? It definitely doesn't just happen by accident. The answer? Human capital. Their producing exclusive agent counts saw some really solid growth, particularly at Liberty National, which was up 8%, and Family Heritage, up 7%. In a world that is completely obsessed with direct-to-consumer digital marketing, Globe Life is proving that a robust, face-to-face, exclusive agent network is still a massive growth lever. More boots on the ground directly correlates to more policy conversations, which ultimately translates to that 7% jump in total premium revenue we saw a minute ago. Which brings us to Section 4, investing the premiums, the background engine. Once those dedicated agents actually secure the premiums, Globe Life puts that money to work in the background through investments. This is kind of the hidden half of the insurance business model. To evaluate how well this is working, management uses a metric called excess investment income. I love breaking down these industry terms because it shows exactly how the business generates value. Think of it like this. They collect your premium, they invest it, they set aside the interest needed to fulfill their future promise to you, and whatever is left over, That is purely excess profit. And this specific excess income metric grew by 10% to over $38 million for the quarter, proving their investment engine is incredibly efficient. When you look at the raw data, their net investment income was actually over $293 million. But after backing out the $255 million needed for required interest on policy liabilities, they cleared a really healthy $38.3 million in excess. It's a huge sign of excellent asset liability matching. And this brilliantly illustrates why they are so unbelievably stable. 86% of their massive $20.7 billion investment portfolio is safely locked in predictable fixed maturities, earning a 5.30% yield. Plus, the source points out that 97% of those fixed maturities are rated investment grade, so they aren't out there gambling this premium money on highly volatile tech stocks or crypto. They are methodically parking it in corporate bonds, municipals, and government agencies to make sure they can weather almost any economic storm. Because of all this stability and excess cash, they were able to return significant value directly back to shareholders, repurchasing $175 million worth of stock. By buying back 1.1 million shares at an average price of $154.28, management is essentially saying they believe their own stock is a fantastic investment right now. This reduction in outstanding shares is also a key reason why their net income per share numbers are growing so aggressively. Let's wrap things up with Section 5, looking ahead to the future, navigating risks, because no financial report is complete without taking a hard look at the potential speed bumps they've got to navigate. Despite the incredible quarter, the source material rightfully outlines a few core risks to monitor moving forward. Primarily, we're talking about economic inflation, regulatory shifts affecting Medicare, and, of course, evolving market competition. For instance, high inflation can really eat into a consumer's disposable income, leading to unexpected changes in policy lapse rates. Furthermore, since their highly successful United American segment relies heavily on Medicare supplement insurance, any governmental changes to the federal Medicare program becomes a massive point of ongoing scrutiny for them. All of this leaves us with one major thought to ponder based on these stellar results. As we look ahead, can this traditional face-to-face agent model really continue to outpace the industry in a highly digital age? Well, Globe Life's Q2 2026 earnings clearly state that, for now, the answer is a resounding yes. Their human capital is driving record margins, their investment portfolio is remarkably secure, and they're aggressively rewarding their shareholders. The numbers really do speak for themselves. Thank you so much for joining me for this explainer, and I hope this helped you to code the machinery behind these incredibly impressive financial results.